Adapt First Investments. I'm a chartered financial analyst, and investors are often confused about where to buy and sell securities in their portfolio. It's not just really enough to identify a good company or a good market. What's even actually more important is to know where to enter or even exit that investment. And that's one of the things I'd like to share with you today. Wanted to give you some insight into how I help guide my clients into identifying strategic buy and sell points for securities in their portfolio. So the example I'm going to use today is a PE ratio. It's a valuation metric which basically gives us an idea of how much a company is worth. So let's take a quick look at that. The first part of that ratio is the earnings, and most people are familiar with that. It's basically just how much profit a company makes from the things that they sell or the service they provide to their customers. And the price is actually the consensus between what the buyers and sellers on the market are willing to pay for that particular company on a certain day. So what we can do is we can look at the ratio of these two metrics, and we can see how much investors are willing to pay for a certain dollar of earnings. And what I do is actually, here I'll give you a chart to show you that. And what I do is actually track this ratio over time, and I calculate an average so I can see over a 3 or 5 year period what the average valuation is for a particular company or a particular market. Now what happens is as news comes out, as investor sentiment changes based on world events and the economy, the price that they're willing to pay for an individual company can deviate from those underlying earnings, and sometimes that can be pretty significant. And the example I'm showing here, where the first part of it, we can see that the price earnings ratio starts to deviate pretty substantially from the average on the upside. And what I've found in my research is that when that deviation gets between 2 and 3 standard deviations above that average, that tends to be a turning point in the stock. Investors could just be so excited about the prospects of the company that they're willing to pay more and more and more, and at some point there's sort of a realization that, well, wait a minute, maybe their expectations aren't being met by the company, and the price tends to come down, and that ratio tends to revert back to the average. The same thing can actually happen on the downside, which you can see here as well, where negative news or problems in the industry, something affecting the company, causes the sentiment from investors to go down, and again that price earnings ratio can fall between 2 and 3 standard deviations below the average, and in that case it tends to represent a buying opportunity for clients, because really the price is so low that it's not really justified by the earnings. And again, we can see a reversal and a reversion back to that mean price earnings valuation. So this is just one of the tools that I use, but I've actually found it to be very effective in my research, and I use that along with some other things to help clients identify great risk-reward situations for their investments. And I would love to share a little more about this with you. And if I can, just give me a call or an email. Put those up here on the screen, and we can schedule an individual appointment. But thanks so much for your time, and look forward to talking to you soon. Take care.